All right, I'm Michael Hartzman. Today is Tuesday, June 2nd, 2026. And I'm on as always with my partner, Dominic Tavella. Looks like you're down in our Florida location. How are you, Dom?
Doing great, Mike. Indoors, not out, so cool and comfortable. No complaints.
Good for you. Well, let's just jump into it. The market closed about an hour ago. So another day, another new high. Seems like it's becoming boring.
You always want to kind of not take these things for granted and take them in stride. But, last week was another plus week for all the major indices. I usually let you rattle off the numbers, so I'll let you do that part of it. But kind of surprising, Mike. I won't lie to you. We're at a stage right now where a little surprised at just how well these markets are performing.
It really is incredible. So I'll do them since you asked for them. The S&P 500 last week was up about 1.5% quarter to date, which is 2 full months now. 16.3% year to date, 11.25%. These are through Friday, last trading day in May. The Dow Jones was up almost 1%, quarter to date about 10.4, year to date about 6.9. And the NASDAQ, the good old NASDAQ, was up a lot last week, 2.39%, quarter to date up 25% in 2 months, and the year to date up 16%. It really is shocking. There's a note in my cheat sheet for March 30th when the market was down from the beginning of the Iran war, which was basically the last day of the first quarter. For March 30th, the S&P has rallied 19%. Now, granted, we've seen this movie several times before. We saw it, during the tariff tantrum last year. We saw it, during the beginning of the pandemic. But it's not anything to get used to, because I'll still argue it's still not normal.
Yeah, look, the quarter to date numbers, and we've talked about this in the past, Mike. We're coming off the bottom after we had a pretty decent pullback. I hate to call it correction. All the major indices were down roughly about 10% from the high, the year high, and once the Iran war started, and then once we'll just say for the sake of this conversation, it didn't look as bad as it potentially could have been. The market started to rally and have continued that. So, but even the year-to-date numbers are pretty spectacular. And I think you asked me this question last week. I'm going to throw it back in your lap. If I would have told you, inflation was kind of roaring back and oil prices were kind of high and gas prices are high and we still have the Straits of Hormuz closed with no shipping traffic, virtually no shipping. Do you think the major index, do you think the S&P would be at an all-time high?
No. No. And to a large degree, it defies logic, other than, and again, we do sound like broken records. It's the AI trade is clearly back on the table, and it's clearly what's moving the market and all things around it. But everything you just said is obviously true. Inflation's back on the table. Interest rate cuts are clearly in doubt, and the Strait of Hormuz, which supplies a lot of the world oil, has been closed, I think now for 6 or 7 weeks, if not more. So no, I would not have believed any of this.
And to your point, Mike, so last week we'll focus on the S&P, hit an all-time high. But would I shock you if I told you only 20 stocks hit an all-time high? So is this technology AI trade now driving the market again?
It is driving the market. And I'll just remind you that you and I are clearly guys whose glasses are half full. And we had your buddy, my buddy, Phil Blancato on the show about a month ago now. And we had a similar conversation a month ago. And when we went to the break, what did Phil Blancato tell us?
I think something along the lines of we were nuts.
We were nuts. And so maybe, and again, we were not negative then. We were cautiously optimistic. Phil was very optimistic, and he made a very good case for it then. So I remain cautiously optimistic because fundamentally the economy is still on firm footing, but the worries that you just ticked off were the same ones 4 weeks ago, and they have not gone away.
And I think one of the most important parts to that comment, Mike, is you got to be very careful about watching the headlines in the news every night. You got to be very careful about the stuff that scares you. And I'm not saying you shouldn't be paying attention. We clearly are. But market timing sometimes gets you caught on the wrong end of the trade. And had we been completely pessimistic when the war in Iran started, we would have missed out on one of the really all-time great rallies in this market. Now, again, we temper the enthusiasm and the excitement and try to be a little bit defensive in our portfolios. But boy, you would have missed out on a big rally if you had bailed out based on the headlines.
Yeah, exactly. And we're not market timers. We never were. You know, we trim the portfolio. We get defensive, we get optimistic, but we've never had a time, even during the pandemic, there's never been a time where we've gotten out of the market or even gotten halfway out of the market, not remotely close to that.
Incredibly difficult. And the old saying, you might get it right once, but you're not going to get it right twice. And in that you might get out at an appropriate time, but finding that right time to get back in is incredibly difficult. So for us, it's always about adjusting risk. And although we've had a ceasefire, I'm going to use that term loosely, in the Straits of Hormuz, it does seem that there is a path possibly to some more permanent ceasefire. And that would be optimistic for energy prices. That would be optimistic for inflation. And then by definition, that would be optimistic for interest rates.
Yeah, and here's the part that's even more potentially insane to me is when that news actually breaks and we actually do get the straits open and we do get a peace in the Middle East to the best of our ability. Down the market is more than likely going to do what at that point?
You wonder, you would think oil would drop pretty dramatically, right, Mike? We just on the rumors, we see it drop 5% in a day. So you would think oil would drop pretty dramatically, and you might get some kind of a short term anyway relief rally. And then I wonder how long it takes for the reality to set in. And we've brought this up as well many times, Mike. A lot of this infrastructure that produces energy, not only in the Middle East, but we brought up the issue with Russia. A lot of this is damaged, broken, needs to be repaired, blown up, right? And that's going to take some time. So we do think energy prices come back down, but maybe not quite as dramatically as some people would hope.
Yeah, and yes, and the opportunity there also is to rebuild these things also costs money. And to that point, not only are our markets doing really well, Dom, but the developed IFA index is up 11% quarter to date and almost 10% year to date. And the emerging markets, and this one always amazes me, emerging market index is up almost 26%, both quarter to date and year to date, and was up almost 4% last week. And they're the nations that you could argue are affected more by the straits being closed than we are.
Yeah, some of those nations are also some of the largest consumers of energy in the world as nations. But I will caution. I mean, we have an exposure in emerging markets. The portfolio has done amazingly well, and we're grateful for that. But just keep in context that like countries like South Korea, Indonesia, Taiwan are in that bucket of emerging markets, and those companies produce a lot of the computer chips and the AI chips that we need. So it's kind of a cause and effect why those particular markets have done extremely well. So again, we're grateful. We own it. We have it. We are capturing that performance. But be careful about jumping into those markets today after the fact.
Right. I agree. So just switching gears, let's talk about what some would argue the more stable, more boring part of our asset allocation, and that's fixed income. And I would argue that fixed income from that perspective gets a bum rap because it's not as simple as people might make it out to be. And there's always plenty of opportunities in fixed income if you know where to look. And there's also pitfalls in fixed income if you don't know where to look. And tonight we have Julio Bonilla, who's a CFA with Schroders, who's one of the portfolio managers on many of their funds, including the core fixed income fund, the tax aware bond fund, and a muni specialist as well, Dom. So we look forward to our conversation with Julio tonight.
Yeah, we can make jokes about how exciting bonds can be, but we've heard some of our own guests and some of the experts in the industry talk about this is an exciting time for bonds. I actually tend to agree on that one. Not as quite as exciting as AI and computer chips, but nonetheless, we're mandated to have this stuff in our portfolios. So this will be a great conversation today.
So we'll be right back with Julio Bonilla, Chartered Financial Analyst at Schroders. All right, I'm Michael Hartzman on the Lebenthal Report, back with my partner Dominic Tavella, and our guest this evening, Julio Bonilla, CFA at Schroders. He's responsible for a couple of funds in their lineup: the core fixed income fund, the tax aware bond fund, and a muni specialist as well. So, Julio, thanks for joining us this evening. And I guess I'll just start at 30,000 feet in the air. Dom mentioned it right before the close that years past, fixed income has presented its challenges, but some of the guys who wear the same hat as you at other places argue that this is a great time to be a fixed income manager.
Yeah, it is, and thank you, gentlemen, for the time. But you're right. Look, if you look at recent history, coming off of zero interest rate policy, everybody was scratching for every basis point that they could find within the fixed income universe. Fast forward to today, and here we are in an environment now where across the board, across all of the sectors, we're able to find yields 5% or higher in anything that's a taxable type security. Within the municipal landscape, we're able to find yields of 4% or higher across the curve. And in the municipal in particular, for your non-qualified money, to me, what's striking is then you do the math where you find the taxable equivalent. And in some cases, you're talking 7.25% taxable equivalent yields. I mean, Michael, if you could have locked that in 30 years ago and just sat on that, right?
Yeah.
Unbelievable. So there is opportunities, but I think the other element, I think you guys alluded to it in your discussion earlier, is, one of the elements that's driving the markets is this inertia from the AI environment. One of the elements that we're seeing is that spreads are compressed. So as you navigate this landscape and you look at these eye-popping yields, you have to ask yourself, am I getting paid the right amount of spread over that risk-free treasury rate to add that incremental basis point for the amount of risk that I'm taking on in the portfolio? And when you look at the markets as a whole, let's just say the corporate bond market, about 80% of the yield that you're going to earn in a corporate bond is coming just from the treasury market alone. So that 20%, you really have to question, am I getting paid? And in some cases, you're not. And I think that's sort of the key driver, right? You have to be judicious in how you're allocating your risk in the fixed income markets, and be very picky about the credits that you're using to fill that bucket that you guys are using to fill for your portfolios.
So Julio, maybe I'm going to give you kind of a loaded question to start, but you lived through a couple of years ago when inflation was sitting at north of 9% and the Federal Reserve was raising interest rates. Explain what that kind of environment does to the value of bonds, and then how does that picture look like today?
Right. So you have to remember you're buying a bond. So you're buying a fixed stream of cash flows. And as interest rates were moving higher, the value of those future cash flows becomes worth less. I mean, the easiest way that I can put it is, as you're watching interest rates move higher, you've locked in these stream of cash flows. Oftentimes people say, well, why don't I just sit in a money market fund? Why would I go out and take that risk? Because what it does is it diminishes the value of your bond, because those cash flows, basically what we do is we take those cash flows out for the life of the bond and figure out what is all that worth in today's dollars. And as interest rates move higher, in today's dollars, those cash flows become worth less and less and less. And that's what ultimately drives down the value of a bond. Now, in that environment, I think again, going back to spreads, as a bond fund manager, we're afforded the benefit of time. Time kind of works in our favor as a bond fund manager. And so one of the other elements that you have to take into consideration is spreads. How much am I getting paid above and beyond the risk-free rate, which is the treasury rate? So in some instances, in that rising rate environment, what you have to be cognizant of is, if you're collecting a disproportionate amount of spread for the risk that you're taking, oftentimes what happens is the market will then reprice that spread a little tighter. So it sort of acts as a buffer or a shock absorber for some of the pain that you might feel as interest rates are rising. If you fast forward to today, we're in that environment where we went through 2022, rates escalated, everybody got to feel it. The new generation of advisors and fund managers, for the first time in their career, experienced what I experienced back in the 90s, where interest rates were moving higher. And I think you get to today, and you're, like I said earlier, you're in an environment where your yields are high, people are fearful of inflation, but the question you have to ask yourself is, are you getting paid enough spread risk for the bonds that you're buying today? Now, the beauty of being a bond fund manager, though, is, unlike an equity manager, is time works in your favor, because eventually your bond does mature. So if you are collecting an inordinate amount of spread on that bond, at the end of the time when bonds ultimately mature, you do kind of end up winning in that game of, I bought the bond, I got an extra amount of spread for the risk I was taking. And at maturity, you look at it and you go, wow, I actually did okay. Stocks, on the other hand, they don't mature. They keep going in perpetuity. So the market could say you're wrong for a very, very long time, unlike a bond.
Julio, let me ask you this. You and Dominic alluded to 2022. And in 2022, the fixed income market just broke. It's just like its brain snapped in half with interest rates, inflation going through the roof, and the Fed, really not cutting rates quick enough. Now there's some fear that rates are going to maybe go up again, maybe not. There's inflation, definitely is either stable or definitely creeping up again. I think you may have answered the question, so I apologize if I'm asking the same question in a different way. But why should investors believe that, what happened in 2022 is a once every 30 or 40-year event? And why is it unlikely? Nothing's guaranteed, but why is it unlikely to happen again now?
Well, I think there's a caveat to that, but I'll start off with what I'm most concerned about, and I think you guys talked about it, right? The Strait of Hormuz. Have you guys heard of the nacho trade? Not a chance that Hormuz opens. So that's the dilemma that the market's facing right now. Every time we get a tweet that the negotiations are taking place, the market's routed. You see oil prices come down, you see bond yields come down with it. Look, that's the big unknown, right? That's what everybody in the markets are watching. That's why everybody's on edge. I think you guys said it best, right? Even if they open the Straits of Hormuz, we're still going to have to rebuild some infrastructure. Oil doesn't naturally come back to where it was prior to the invasion. So that element of it is the big unknown. Let's put that aside for now. What we do have, though, is we do have a big stimulative effect right now that's taking place, very similar to what we had when the Fed was stimulating the economy during COVID. Except this instance, it's not the Fed, it's the hyperscalers. They are spending an insane amount of money building their facilities, buying chips, hiring people, procuring concrete, you name it, whatever you need to build those facilities, whatever you need to buy the chips or to manufacture the chips, it's consuming an incredible amount of resources, and it is driving our economy. If it wasn't for those hyperscalers, arguably GDP growth here in the US would either be flat or even possibly negative, if you can believe that. If I look at Google, for instance, they just did an equity offering. Berkshire Hathaway was a part of it. If that gives you some comfort with that issue. But they basically raised $80 billion. These guys are going to spend about $190 billion this year. That's just one company. Expectations are they're going to spend $300 billion next year. So the amount of money that these companies are spending to build these facilities is moving the needle in the economy, but it's permeating the entire economy. Your clients, my clients on the stock side are feeling it. In the bond market, we're feeling it. In the ABS securitized market, they're feeling it. In the private markets, they're feeling it because these guys are tapping every single market to raise dollars in addition to their free cash flow to continue to build these facilities. They're going to spend trillions of dollars in the next few years. So that does move the needle for the economy. In fact, if I put my muni hat on, you look at the great state of California, that is highly dependent on the top 1% earners in that state. They don't have a revenue problem in California. They are making so much money through the stock options of these tech companies that they are in a position where I have never seen a state have so much cash in the hundreds of billions of dollars, highly dependent on these tech companies. But you look at the muni side of it, what these guys really have is a spending problem over there in California. But the revenue is extraordinary. You come over to New York, you look at bank earnings. When I'm buying corporate bonds, the bank earnings, every year it's a record-breaking year. Wall Street bonuses, record-breaking year. Why is that? Because of the bond deals, the equity deals, the M&A, the private deals. It doesn't stop. So yeah, that's moving the needle. That's stimulating the U.S. economy very much in the same way the Fed was stimulating the economy during COVID. So as you guys alluded to it, right? The stock market's doing great. Everybody's feeling really great. But here's the catch. It's stimulative, it's inflationary, but the real true beneficiaries are a very small subset of the economy. And I think you guys have maybe in the past talked about the K-shaped economy or the K recovery. So you have the upward sloping part, which are the wealthy. Let's call it the top 20% earners here in the US. That top 20% of earners in the US represent over 2/3 of spending of the US economy. The bottom 80% represent a much diminishing amount of spending power here in the US. So as you look at who are the beneficiaries of all of this economic activity, it's just a small subset of the US economy. So as long as they continue to spend, as long as the economy continues, I think we're going to be in an okay position. But I think the element that is sort of dragging things down and where I think the Fed is trying to be cognizant of is that bottom 80% of earners who are struggling. They tend to be renters. They're the ones that are feeling the brunt of these higher prices at the pump, at the grocery store, and in rents. And I think that's where the Fed is a bit more cognizant about who is being impacted by what here in the economy. But the dilemma that the Fed is facing right now is they can't cut interest rates because, as you guys said, we are in an inflationary environment. We are facing a Strait of Hormuz that is pretty much closed. So until all of these elements can get resolved, and we can get more clarity as to how much inflationary impact the hyperscalers are going to have in the economy, our expectation is you can't see the Fed cut. But now that's a positive. And what I can tell you is what the markets want to see, the long end of the bond market, what they want to see is they want to see a prudent Fed. Remember, the markets are always forward looking, not backward looking. So if we get a Fed that is cognizant of what's going on in Iran, cognizant of what's going on with the hyperscalers, and is prudent and withholds from cutting, but maybe possibly considers a hike, just one hike, I think that gives the markets a lot of comfort that the Fed has their eye on inflation and they're going to manage it well. So I think that's something that you have to be cognizant of as you're entering the fixed income universe is what's the Fed going to do? What are they articulating they want to do? And the markets will react in a way that is much more forward looking. So from our perspective, you're earning a lot of yield, pick those safe bonds, hide out in very high quality securities, but more importantly, it's just be cognizant of the fact that we're probably at the higher end of the spectrum of where rates are going to go if Hormuz does turn out the way that we hope it turns out, and if the Fed makes the decision that they're going to be more judicious in terms of what they do with Fed funds rate.
So Julio, there's a lot of questions in that. So I just want to focus on one simple one first. So there's obviously all these scalers, AI, technology, data centers. Yes, they are spending their own money. They are issuing stock, but a lot of them are borrowing money to do these enterprises. Are they sucking the oxygen out of the room? Do you see the demand for money as taking money out from other areas in the economy, or competition forcing higher interest rates?
Yes and no. What it's forcing is it's forcing us as allocators to decide, do I want to own an industrial company versus the hyperscaler that's higher quality, bigger balance sheet, insane amount of cash flow, even with the debt that they're issuing, the leverage is still low than the industrials, but I'm getting more spread for the same maturity in the hyperscaler than I'm getting in the industrial name. So it's putting pressure on spreads for the industrial issuers. It's putting pressure on some of the financial issuers. So I think that's one of the issues. However, when these deals come to market, we're finding these things are 10, 15 times oversubscribed. So you have a $10 billion deal, you have $100 billion of orders. It is extraordinary. Now, where's the money coming from? It's coming from foreign buyers. It's coming from domestic buyers. It's coming from institutional buyers, whether it's pension funds, foundations, endowments, insurance companies, both domestic as well as foreign. As you guys said, Schroders is a global organization. I can tell you that whenever there's a deal that comes to market here in the US, my counterparts, my colleagues in London, my colleagues in Europe are all looking at the same deals and participating in these deals. It is truly a global market, and everybody is gravitating to the highest yielding fixed income market. For those investors that are overseas investors, what they're doing is they're looking at what is the cost for me to buy that bond and then take that dollar security and then convert it back to my home currency. And if net, it's a positive trade, I'm going to do that trade. And right now it's a positive trade for them, just given the high absolute yields that they're able to earn on these very high quality issuers. So yeah, it is crowding out some of the other issuers, but boy, there is a lot of demand for fixed income right now.
Well, getting back to the Fed, I recently heard an expression that the new Fed chief, Kevin Walsh, has been floating, using the term trim means inflation, which apparently filters out the volatile prices, in our economy. And as you mentioned, to 2/3 of the economy, you could call it anything you want. Things still cost more money, and it's going to affect their wallet. So when you look at an expression like that, do you put any weight in that thesis? Is this, like when Powell was calling inflation transitory back in 2022?
Right.
Is this a theme that others will buy into, or is this a theme more geared towards an audience of one and to justify lowering interest rates?
I don't know if he necessarily is trying to justify an agenda. I think what he's trying to do, and I'm a huge Warsh fan, but what I would say is I think he is trying to correct some of the flaws. So when we look at some of the economic data that these guys are putting out or that they're looking at, it's not perfect. We all understand it's imperfect. And I think what he's trying to do is try to correct some of the flaws that he's sort of observed in his years at working at the Fed. And I'll give you an example. So housing is an element in CPI, right? It's about a third of the CPI. It's about 17% of core PCE, which is what the Fed's metric that they like to use when they're looking at inflation. But here's the problem. When you get the number in the CPI or the PCE, that housing inflation number is over a year old. It's basically looking at what happened to the housing market 12 months ago. So it's backwards looking. I mean, I don't know about you guys, but when I drive a car, I don't like to look in the rearview mirror. I like to look forward. So I think that's sort of the dilemma that he's facing, is he's trying to correct some of the flaws in the way that they're accumulating the data, they're interpreting the data, and then they're acting on the data. He wants to be more forward-looking, not backward-looking. So I think if he explains his process, if he can convince the other governors that this is the way they need to go, I think the market should receive it well. What I will say is this, though, deviating from the 2% target, I'm not sure that would be well received by the marketplace.
So inflation is such an important component of what you do. And we've seen with the war in the Middle East, we've seen inflation expectations go higher, interest rates went higher. They just kind of recently started to roll over as oil prices have come down. What's your expectations for at least the balance of this year?
So I think we're going to hover around this range. I would say right now, if I look at the 10-year, we're sort of in the middle of our expected range. We were in the 425, 475 camp for the 10-year. And the key reason is, as these higher oil rates start to hit our economy, as they start to hit the pocketbooks of America, the problem is that it sort of creates this demand destruction. It's people are having to allocate money away from other goods or services to pay to fill up that gas tank. It's not as if though they have an extra dollar to allocate to the gas tank and then continue to allocate like they normally would want to allocate. So it is, to some degree, going to eliminate growth in other parts of the economy as people start to reallocate their resources to fill up their gas tank. So my expectation is that 475, I'm comfortable with that target, more so because the impact that it has on the economy, but more because it forces the Fed to then have to make the decision, are we going to have to raise interest rates? So there's a part of the market that's, these are called Fed funds futures markets, where the market investors will make investments based on what they think the Fed will do in the future environments, right? And it goes about every month or so. And these markets sort of fluctuate quite a bit. But if you look at those markets, what they're prognosticating is that the Fed's likely to hike rates by about 25 basis points, a little bit above that. So any discussion that Warsh is going to cut interest rates, the markets are telling me the opposite. And to some degree, if this continues, the markets could ultimately force the Fed to actually hike interest rates, because that's what the markets are starting to price in. And that's why I said earlier that if the Fed were to cut interest rates, you would have a very negative reaction on the long end of the market, because that would give an indication the Fed does not have its eye on inflation like we are expecting as market investors. You guys heard the term bond vigilantes before, right? That's the market reacting. That's the market saying, oh my God, the Fed cut. And people start to sell off their long security, duration securities. The big institutions start to do it. If the Fed hikes, it gives everybody comfort. Okay, these guys have a handle on it. They're doing the right thing. And then we start to get more aggressive, again, forward-looking, aggressive in trying to buy more of the long end, because it gives us more comfort that the Fed is moving in the right direction.
Julio, I know we're bumping up against a break, but I want to keep this train of thought going. This makes me believe I'm in Economics 101. You're my economics professor. Couldn't or wouldn't you make an argument that the higher price of gas, which you mentioned, which directly affects people's pocketbooks, which directly can slow down the economy in and of itself, could you make an argument that that's enough of a buffer not to have to raise interest rates because we're already slowing down the economy as a result of this?
Yeah, you can make that argument. But again, that's why I bring up the hyperscalers, because we're trying to dissect the effect that oil is having on the broader economic environment in terms of prices and how much of it is hyperscaler related. And I think trying to dissect those two is a pretty messy game. So that's why we have those two elements. We're trying to figure out which one is driving how much of it. And I don't think we have the answer quite yet.
Gotcha. Well, thank you for that answer, and thank you for doing it quickly. We're still in the framework of the break. So we'll take a break here, and we'll be right back with Julio Bonilla, CFA at Schroders Investments. All right, I'm Michael Hartzman back on the Lebenthal Report with my partner Dominic Tavella. He's live in Florida. And from New York City, Julio Bonilla, CFA at Schroders, involved in all things fixed income. Dom, I know it's your turn. I monopolized the last part of the first segment. You go ahead.
I don't know if monopolize, but thanks, Mike. So Julio, again, I apologize for the loaded question, but probably the world's biggest borrower is the U.S. government. I'm saying probably because I almost don't want. I'll let you confirm that definitely. But we keep hearing that how much can they keep borrowing and how much can they get away with? And look at our national debt. I'd love to hear what you have to say on the subject.
God, everybody loves to ask that question. Frankly, we don't know how much we can borrow. Look, at the end of the day, we are the reserve currency, right? We are not the UK. We are the largest economy in the world. Look at these hyperscalers. They are driving our economy. They are impacting other economies. They are spending more than some countries would ever spend. We're an extraordinary market. We are the only game in town. If you're a large institution on a global basis and you have Treasury securities, you're an insurance company, a sovereign wealth fund, there is no other alternative other than U.S. Treasuries. It's not like you're going to sell $300 billion of treasuries and then go deposit those in bonds or forget the ruble. My God, there is no other alternative. So the key question is, how much can we issue? We really don't know. You can look at Japan. Japan has multiples of debt to GDP that we would have. So I would say that there's definitely been rumblings that we got close to what was a breaking point. I'm not sure we're even near that. Again, I look at the money markets, for instance, and we have over $8 trillion sitting in money market instruments. That is a lot of dry powder. As I said earlier, when these debt deals come for $10 billion deals, and we have over $100 billion in orders. So to me, the number can be substantially larger. Do we want it to be? I don't think so. Do we want a significant part of our federal government's expenditures going to interest payments? I don't think so. I think there are better uses of our government's money. But I don't think we're anywhere near the point where we're going to have a run on U.S. Treasuries anytime soon. We have a long, long runway here in the U.S. as far as I can tell. But frankly, I don't think anybody knows for sure what that number is going to be.
Julio, I agree with you. But my question is, earlier this year, this administration seemed to really upset a lot of NATO nations, and some people arguing that the reason the price of gold went through the roof is people were selling their treasuries, selling their dollars, and buying gold as a reserve currency.
Right.
And I agree with you that we are still the standard, but do you worry about us isolating ourselves to a point where we do not become the reserve currency of the world?
So it's funny you bring that up. So as you know, Schroders is a British firm,
Yeah.
and we have pretty good banter with our colleagues in the UK. So I remember we had a strategy meeting, and they were ranting and raving about it was the end of the U.S. It was the end of U.S. exceptionalism, and they were kind of happy about it. But in the same breath, these investors.
Wait, Julio, this was the Brits? They're the ones.
Brits. No, of course, yes.
Talking about calling the kettle black or whatever that line is.
In the same breath
sorry.
as they're calling you the end of U.S. exceptionalism, these guys are sending us $1 billion to buy U.S. mortgage-backed securities. So what was really happening with the dollar was this. You had some big institutional investors in Southeast Asia that have a lot of money tied in U.S. dollar-denominated securities, and it's unhedged, meaning they didn't have the currency hedged, and all they started to do was hedge the currency. So that's what was driving the dollar. They were not selling their securities.
Okay.
Which is why I said we don't know what would crack the market in terms of people exiting our markets. What multiple in debt to GDP would it take? Nobody knows for sure. But for now, as far as we can tell, we're the only game in town. And that was the telling point for me when they started to send us money in the middle of that meeting.
So Julio, just now to put you on the spot, right? So in our portfolios, we're mandated by the portfolio allocation to have a certain amount of fixed income bonds in the portfolio. We look at money markets and treasuries and corporates and munis and high yield and international, emerging markets. Where is the best opportunity right now?
I would say that in this environment, for your qualified money, you want a very active manager that is benchmark agnostic. You don't want somebody who's going to hug the benchmark because there are too many pockets of problems within the broader market. You want a manager that's going to be very discerning on where they allocate in the high yield market or in the IG market within the taxable universe. And I say that because as I look at the landscape and I see what people are paying for various types of structures, I know what I want to avoid and I know what I want to own. And I'm an agnostic fund manager. If I don't like a sector or our team doesn't, we don't buy it. So this is going to be a true active managers environment where they're going to shine versus the index funds. For your non-qualified money, I would say you would want to split it up if you're going to buy at the long end, you're going to add duration for your non-qualified money, you're going to want to own some munis. That's really going to be the best value for your buck. At the very front end for your non-qualified money, you're going to want to own taxables. You're just not getting paid to own munis at the front end of the curve. SMAs have grown over the years. It's over $1 trillion in muni SMAs. They tend to focus on the front end of the curve, and they've driven the valuations way too high.
Hold on, I'm just gonna, because we have a lot of listeners, a lot of viewers. What do you mean by the front end of the curve? We know what you mean, but just explain it to our listeners.
I'm going to cuff it at about 10 or 12 years and shorter. So if you have something that's labeled an intermediate fund or a short fund or a short intermediate fund, you're just not getting paid a lot to own the very front end of the muni market. So if you were to allocate to your non-qualified money, if you were able to carve it up by duration, you would hire a taxable manager to manage the short part of your non-qualified money, and you would use a long duration muni manager to manage the long part of your portfolio for the non-qualified. But without a doubt, obviously for the qualified, pure taxables, again, on in any one of those buckets, you want an active manager, because I think indexing isn't going to work in this very tight spread environment where we're all seeing story bonds. When I talk to my high yield managers, my buddies that sit right next to me, they're telling me, Julio, I'm buying very specific names. I'm buying very specific sectors. I'm avoiding the rest of it. When my high yield manager is buying triple B bonds, because a triple B bond is considered investment grade, when a high yield manager is buying triple Bs, investment grade bonds, that's telling you he's not finding a lot of opportunities in his space.
So, and I'm sorry, Mike, just to have him expand on global bonds.
So within the global bond space, the same can be said. So on the non-US part of our portfolios, we're focused predominantly on the IG side, whether it's IG sovereign or IG corporate. Again, very select stories. There are specific countries where we like the companies in that country, and we like those specific countries. It's not a blanket, okay, where the EM team is saying, okay, we want to be invested equally across all of the different issuers across Latin America and Southeast Asia. It's very select stories. And again, I think it's going to be the active managers in this type of an environment where spreads are compressed, balance sheets to some degree for some issuers are stressed. But I think more importantly, and this is, I think, the key element, is the covenants. It's all about the covenants in this environment. And I think that's what's most concerning. So whether it's the private markets or the public markets, that's one of the key elements you have to be most fixated on are your covenants. Are you buying a bond? Because like I said earlier, there's a lot of money chasing a very small amount of bonds. In those environments, when the party gets crowded, the issuers get to name the terms. So we have to be cognizant of the terms that they're giving us. And am I being paid for those terms? And that's why I say you have to be picky and you have to be very selective on the stories that you're buying. And that's why active managers, I think, will shine in this type of environment.
Julio, switching gears a little bit, you're sitting I think you're in Midtown, so you're sitting in the middle of New York City. Is the death of New York City exaggerated? And is there any reason to fear owning a New York City municipal bond, whether it's a transit bond or a Port Authority bond or a dormitory bond? That's always been in the New York muni space, kind of the safe paper is going downstate. Has your opinion changed at all in the last year or so?
No, I think from a fundamental perspective, I think New York is doing fine. I think they're in the same boat as California. Their revenues are growing. What they have is a spending problem. Now, look, just like any other municipality or any state, if they start to face deficits, they're just going to cut services. They're going to have to cut services. They have to balance the budget. That's what they do. But as far as revenues are concerned, the state is not dead. The city is not dead. It's actually booming. Like I said earlier, the state of New York is highly dependent on Wall Street. Wall Street bonuses, record years. SpaceX is about to do an IPO. I think the number that I read is that the banks are about to make about $300 million in profits off of that IPO. So I think it's going to be a very good year for the city of New York. The steakhouses, the fancy car dealerships are going to do just fine with the bonuses that are probably going to be filtering through Wall Street right now. So no, I'm fine with, from a fundamental perspective, I'm fine with the broad muni landscape. I would say the only area, and I think it's more longer term versus shorter term, that I would be most concerned about would be healthcare. Healthcare is probably the one area that I think is going to have some pain, and that's tied to the big beautiful bill. One of the elements of the big beautiful bill is they had to pay something to pay for it, and one of the pay fors was Medicaid. Medicaid is going to get cut about $1 trillion over the next 10 years. So what that means is that's going to filter down to hospitals. They're the ones that are going to feel the brunt of that $1 trillion in Medicaid cuts. It doesn't really start to ramp up until 2028, and I think that's when you'll start to see pain. So it's not today, it's not next year, but come 2028, I think that's where we'll start to see more issues within the healthcare space. And I think the bulk of it is going to be in smaller, high-yield, rural hospital type systems. The larger multi-state systems, I think they're going to manage okay through it. It's not going to be easy, but I think they'll manage through it. The key question is, do states like New York, Texas, Florida, California with large populations, are they going to fill that gap with money out of their own coffers? We don't know the answer just yet, but that's one of the resolutions. Do the local municipalities try to fill the gap for their local constituents? If they can't, it just goes back to Muni 101. If they don't have the money, they just cut the services.
Or raise taxes.
Or raise taxes. You said it, not me.
I own it.
So Julio, I mean, based on what you just said, some of these larger states are in pretty good financial place, but we're hearing rumblings of Chicago, Illinois. Are there any states, municipalities that are worrying you that we should be looking out for?
No, look, even Detroit's doing well. Illinois just passed a budget. Look, I think they're doing okay. Illinois and Chicago still have their unfunded pension liability. That hasn't gone away. That's still there. It's still massive. But that being said, they have a long runway. They can address it if they make the right decisions. So from where we sit, I don't see in your traditional municipal issuers, whether it's cities, counties, and states and schools, I don't see any serious epidemic of some kind or another for a sector. There are going to be the one-off issuers that are mismanaged. Don't get me wrong. But I don't think, and again, that's where the active management comes into place. But I don't think I could make a blanket statement that I'm concerned about a specific sector other than the healthcare sector. I think that's the only one that down the road is going to give me pause. But the rest of them, at this point in time, I'm not that concerned.
Julio, let's talk about treasuries again for 2 seconds. Crystal ball time. Right now, the 10-year through May 29th, which was Friday, was sitting at 4.45. The 30-year was sitting at 4.99 and was well over 5% a week or two ago. If you were a betting man, where would you think or predict, if you're allowed to make a prediction, where the 10 and the 30-year will be at the end of the year?
Well, I would say 450, which is the middle of the range for us. Like I said, 425, 475 is our high and low. 450 is right in the middle of the range. And then the 30-year, I'm going to say we're probably closer to a 485, 480 yield.
Were you guys licking your chops 2 weeks ago when it was well over 5%?
Oh,
or was it too far out to go?
475, we were ready to pull the trigger and start adding as much duration as we could in our portfolios. 100%.
So I'm pleased, and I know we kind of touched on this a little bit earlier, but we were looking at the same numbers, and yeah, maybe we thought we may not have hit the high watermark, but we had to be pretty close. I was seeing pretty high numbers based on what interest rates are and where we think they're going to be at the end of the year. So I'm going to kind of rephrase the loaded question Mike just gave you. Do you think we hit the high watermark for the year, and hopefully we'll be lower by year end?
I think we've set the high water mark, but I think we can hit it again depending on what happens in Iran. If the situation escalates, I wouldn't be surprised to see us hit it again. But what then happens is, and it happens every time, we start to hit those high water marks, and guess what? The money starts coming in. People start allocating to the U.S. My colleagues in London, my colleagues in Europe, they start sending me money to buy more bonds for them here in the U.S.
And that pushes the prices down.
That pushes the prices back down again.
The yield down, sorry.
That's correct.
Excellent.
And, when it comes to treasuries, there's never an inventory problem.
Well, that's true too.
We'll just keep making more. So Julio, we don't have time to jump into a new topic. So thank you very, very, very much to working a little overtime tonight and making the time for us and for our listeners on the Lebenthal Report.
My pleasure. Thank you.
Appreciate you explaining it to us and the listeners, and hopefully we'll see you again one of these days.
Thank you.
And Dom and I will be back next week on a new edition of the Lebenthal Report. Have a good night, everybody.